pleased to have Brunno Maradei. Brunno is the Global Head of Responsible Investment at Aegon Management. Brunno has worked in the finance industry for the last 20 years. She has worked in several institutions as JP Morgan, Morgan Stanley, the European Investment Bank, and the World Bank Group. Today, Brunno is going to share with us their experience in Aegon, telling us their path to sustainable finance. Also, she's going to talk about the barriers and opportunities that they have found in this process and what they are doing currently on this arena. Thank you so much, Brunno, for being here with us.
Thank you very much for having me at this event. Through the next 20 minutes, I'm going to try to talk you through the story of Aegon as a sustainable investor. To do that, let me share my screen with you so you can see some of our presentation that we've prepared for you today. So Aegon, who are we? Let's start there because some of you may not know who we are. Aegon's mission in the world is to help people achieve a lifetime of financial security. We provide life insurance, pensions, and asset management for 30 million customers worldwide. We are gaining about 4 million customers a year. Last year we had. And our history dates back more than 175 years when we came together as a number of Dutch life insurers merged to become Aegon in the 19th century. We employ about 22,000 people. And as of last year, in fact, as of March this year, we had 940 billion euros entrusted to us in investments that we manage for our clients. Aegon Asset Management, the firm that I work for, is Aegon's dedicated global asset management company. We're a global company as well. We serve customers in Europe, Americas, and Asia. We focus really on institutional markets, and we're very much active managers. We're research driven, so we believe that active management can really drive performance and deliver the best results for our clients. We consider ourselves a responsible investment leader because we have a long history of operating in this market as well. We have a lot of experience in-house. The asset manager employs about 1,200 people, 380 of which are investment professionals. And it's important to note that we've been a carbon neutral business since 2016. So operationally, we try to live the values that we espouse for our investments as well. The asset management firm currently has almost $500 billion under management. We also have some strategic partnerships in France with La Banque Postale, and in China with Aegon Industrial Fund, and in Brazil with Montgeral Asset Management. So what is this history that I talked about? We started really opportunistically 30 years ago. We saw an opportunity to launch certain funds that our clients were asking for, essentially. Back in '87, Real Assets in the US closed its first investment in a low-income housing fund. And soon after that, we launched our first ethical strategies in the UK, which are some of the oldest ethical funds in the UK market to date. So that means for 30 years, we've been running these kinds of funds that really take environmental, social, and governance factors into the heart of the investment strategy. But in fact, we haven't stopped there. I think good milestones to think about is in 2008, Arm UK, which used to be Kames Capital, joined the PRI, and 2011, the whole of Aegon Asset Management joined the Principles for Responsible Investment, which was a nascent industry association back then. So we're almost really a founding member of that institution. We've also been very much involved with the Global Real Estate Sustainability Benchmark, GRESB, which is also a very important initiative in the real estate space. So we've always tried to be very good industry citizens with responsible investment, and we've been learning for a very long time and sharing our ideas and knowledge with other players in the industry as well. I think it's been a real journey. It hasn't always been easy. So I would say that at the beginning, we really started out opportunistically. As you can see, we launched some products that our clients were asking for. It was really only around 2010 that the whole perspective started changing within Aegon, and there was a real recognition that we needed to be also take this this idea of sustainable investing more into the heart of the company, to the core of its strategy. And that's where you see in 2010 that we developed this central responsible investment framework and policy. We developed a team, and that's when really things started coming not just from a bottom-up perspective, but like back in the 80s, but actually from a top-down perspective as well. So at the top level of recognition that the strategy needed to change. And I think as time has gone on, we have essentially been winning hearts and minds within the organization. So we have hired people that are passionate about sustainability. We have converted some others that perhaps hadn't thought about sustainability as relevant for their business. And it's a slow process of education, of exchange of ideas, of finding out what makes sense, of obtaining the right data, of analyzing that data to see what kind of insights it can give you, and just breaking down barriers, essentially, of understanding sustainability. Today, we consider responsible investment one of the core capacities of our firm, and we have about $260 billion in what we call responsible investment solutions. So these are investment strategies that take environmental, social, and governance criteria into the heart of them in some way, shape, or form. We engage, we have an engagement program that's quite large for the size of the asset managers, so almost 600 engagements we conducted last year. And that means we are, that's quite unusual for a fixed income specialist investor. So the bulk of our assets are in fixed income, but we treat the balance sheet of the company agnostically, so we don't care if we're bondholders or shareholders. We still reach out and talk to the companies in the same way. And we find that they're equally receptive as well. We're very well rated by the PRI, and I'll talk a little bit about the framework, which it really has 3 pillars: ESG integration, active ownership, and 4 different types of solutions that we offer. Let's start with integration. What is that all about? So when we talk about ESG integration, we really consider this part of our fiduciary duty. Just being a good asset manager means you have to take into account environmental, social, and governance issues, because we consider this to be financially material issues. So this is really in the hands of the investment teams that conduct our bottom-up fundamental research, and their job is to make sure that they haven't missed anything, that any financially material sustainability factors are taken into account in the valuations that they are modeling for the firms that they are considering. The process for ESG integration consists of these 4 steps that you see on the right-hand side here. Essentially, first, we are seeking to identify ESG factors that are financially material. We then assess the impact of those ESG risks or opportunities on the fundamentals of the issuer that we are considering. We then incorporate that fundamental impact into our modeling and into our recommendation and discuss that with our portfolio managers. And finally, it's up to the portfolio managers to actually think about the analyst recommendation and to see whether the investment is being offered at an appropriate price, considering the ESG opportunity or risk that's being researched and incorporated into the fundamental research that we provided. By the way, this is not just a process for corporate issuers. You know, generally speaking, a lot of asset management firms will talk about corporate issuers, and they'll talk a lot about equity particularly. We find that there are material ESG factors even in other asset classes like alternative fixed income. We have an ESG due diligence process for our private debt. We have an ESG due diligence process for our multi-manager strategies, where we are considering how fund managers are taking into account ESG factors. And we also consider them, for instance, when we talk about sovereign credits and when we talk about structured credit as well. So all in all, the approach of ESG integration across the firm is systematic. It spans all asset classes, and we consider it part of our fiduciary duty. It's really core to how we invest. To give you an example, to bring it to life a little bit, I wanted to show you the integration process for corporate credits. So here we developed a proprietary categorization methodology where this helps research analysts communicate to the portfolio managers how they see the ESG risk profile of a particular bond. And they take inputs from many different sources. They have direct engagement with companies as well. They use specialized data as well, and the responsible investment team also helps them understand that. And out of that, we come up with these 5 categories, where the 5th category is really the worst of the worst in terms of ESG risk. This is where we are taking an S&P's or a Moody's rating, and we're saying, actually, we need to downgrade internally that rating because ESG factors are impacting the credit rating of the firm. On the other end of the spectrum, we've got these responsible leaders where we see the issuer that is such a leader and so avant-garde, let's say, on sustainability, that we think they are particularly well positioned to be a good credit for us, and we should see that reflected in the spreads that you see or the price that's being asked for the bonds that we're being offered. Moving on to active ownership, as I mentioned, this is about entering a dialogue with companies on sustainability issues and exercising our voting rights as owners. The whole concept of stewardship through engagement and voting is really driven by 3 motives that are not necessarily mutually exclusive. Either we're trying to generate long-term value, so we are encouraging companies or issuers to change because we think it will create long-term value for us as shareholders or bondholders. We might be engaging with them because we're doing some in-depth sustainability or impact research, so a lot of our engagement is asking for more detailed information than available necessarily in the corporate disclosures. And finally, of course, we have certain standards, certain sustainability standards that our clients adhere to. And so we also talk to companies about adhering to those standards where we feel that they are at risk of failing them or failing them actively. So the active ownership program is quite comprehensive at Aegon Asset Management, and it's important to note that this is where you can really point the finger at investors having a voice and having an impact in the world, because me buying shares on the secondary market in the stock exchange doesn't really drive change in any way, shape or form. I'm merely refinancing another shareholder. Okay, if you're buying green bonds in the primary market, perhaps your impact as an investor is larger. But most investing that happens today by portfolio investors like Aegon is indeed on secondary markets. And there it's hard to point the finger and say that investors are having a direct impact, what's often called additionality. Where investors like us can have a real impact is indeed in how we behave once we've bought the investment. How do we behave as owners of that investment? And in encouraging the right dialogues and the right change. So I'm a big believer in the impact of investors through active ownership. To bring it to life a little bit, here's an example. We are talking to a company about climate change, a steel company, and it's particularly difficult for steel companies to deal with the effects of climate change because a lot of their processes are energy intensive and in fact use a lot of coal or carbon related products in their processes and their manufacturing processes. So it's been a long dated engagement. I've been talking to this company for a long time with in a collaborative initiative. So we are collaborating with other investors. This is often the case for us. We find that the most impactful engagements is indeed when we join forces with other investors, because we're too small to make a difference with the largest companies. You know, if we were to knock the door of Shell or something like that, we wouldn't be very well listened to unless we were in a group of investors that are equally minded. So it's very important to collaborate with other investors where possible, where there is a meeting of minds and we have the same objectives. We have a proprietary tracking system to make sure that we are following up on engagements fully, and that we can report that back to our clients as well. And to our research teams too. Our research teams are very much involved in these engagement efforts because they find that it is quite useful. Quite a lot of information comes out of this process, which helps them in their fundamental analysis. So there is a virtuous circle between engagement and research happening as well. To give you a sense of the scale of our activities, as I mentioned, almost 600 companies engaged in 2020. Most of these are already reaching milestones 2 and 3, as you can see, where milestone 2, we've started a dialogue, and milestone 3, we're already progressing towards the engagement goal. We're very much still focused on Europe and North America. That's by virtue of where we invest, so that's not necessarily a bias, but just where most of our portfolio happens to be. And you can see that there is a bias here towards governance topics on engagement, and this is because a lot of our engagement is also driven as shareholders through the AGMs and through what's on the ballot at annual general meetings, and what's on the ballot at annual general meetings is predominantly governance issues. So a lot of our engagement focuses on governance issues as well, which is really core to our fiduciary responsibility as an investor, to make sure that the companies we invest in are properly governed. And in sector terms, it really is a broad spectrum of companies that we are reaching out to there. I mentioned collaboration, so these are some of the organizations that we are a member of and that we collaborate with. Particularly important to mention here, Climate Action 100. We find this a very active and very important group to be a part of. But also the Farm Animal Investment Risk and Return Initiative is very good. Principles for Responsible Investment, Share Action. So all of these organizations, and generally our philosophy is, if we join an organization, we want to carry some weight too. So we're not, I don't favor us joining organizations to co-sign, to make use of letters that are coming around. If we are in an organization, we tend to try to be as active as possible in that organization as much as we can anyway, given our limited resources, to lead certain engagements, to pick up our weight as well, and to help others. I think that's very important. Moving on to our products. So once you've reached what I've been talking about in terms of ESG integration and active ownership is really something that we do across all traditional investments. All of our portfolios apply these principles of ESG integration and active ownership where it's relevant. But then we come to certain specialized responsible investment solutions, and this is where it gets even more interesting. This is where we're taking environmental and social matters really into the heart of the investment strategy. And that spans 4 different types. And a good way to think about it is ESG integration, active ownership being done across the board. So you see that blue bar at the bottom there applies across 4 types of strategies. Traditional investments having the sole objective of obtaining competitive financial returns. The first level up for ESG is the simple exclusionary approach. And here we're taking ESG criteria to come up with an exclusion list. And it's really just about managing risk in a rather blunt way. You're just basically excluding certain activities because you don't want to be involved with them. It makes people feel good about their investment portfolio, but it has limited impact unless it's done at enormous scale, like for instance, tobacco exclusion. So in terms of impact, exclusions are usually not very effective unless you're talking about a huge investor boycott movement. Best-in-class approach is where we are already seeking some sort of outperformance of the market or alpha by investing in companies that are superior in the ESG profile or their sustainability profile to their sector peers. So the way I like to think about it is, ESG here is driving your bond or your stock selection, but it's probably not driving your sector selection very much. You're trying to stay broadly diversified across sectors, but you're selecting the best in class within those sectors and trying to find outperformance in that way. Next level up to that is sustainability themed, and how we interpret sustainability at Aegon is to invest in issuers that are actively solving big sustainability challenges of the day, or indeed set to profit very well from certain key sustainability megatrends. So what are we talking about here? We're talking about, I'll go into a bit more detail into the types of trends that we see are as key profit generators, let's say, for issuers. And then finally, impact investing. Well, here, the objective is we have a dual objective, and it's a parallel objective. So we are not only trying to achieve a financial return, a competitive financial return, but we're also trying to achieve a measurable environmental and social impact. And that's part of the promise that we make to clients. So when we do impact investing, we're not only making a financial return promise, but we're also saying we will report back to you on the environmental and social impact of the strategy that you've selected. Important to note here, it bleeds into philanthropy a little bit. We don't play in the philanthropy spectrum here. Every impact investment that we make, we feel is fully competitive and will provide full market returns. We do not engage in philanthropic impact investment of any kind. So in more detail, exclusions, I won't spend too much time on this, but some examples are the ethical funds that I mentioned we started in the 80s. These are usually just based on certain values or beliefs. The ethical funds is an interesting example because here, every 2 years, we poll every client in the ethical fund, and we ask them, what is it that you don't want us to invest in? And so they actually drive that exclusion list themselves, so that we can make sure that this portfolio ends up looking very clean from their perspective, or in that sense doesn't do any harm from their perspective. So it's really a do no harm approach. The aim is really to limit the exposure to what are perceived as damaging practices and activities, things like coal power generation or human rights abuses or animal welfare violations, for example, or tobacco. Moving on to best in class, here we, as I mentioned, we are selecting issuers with improving ESG performance within a certain peer group. And it goes beyond just mitigating ESG risk. It will vary depending on the type of strategy that you're doing. And it's really focused here. The key difference between this and sustainability themed is that you're really focused on how companies go about doing their business. So you're not making a judgment call on whether the product that they produce is great or not for the world. You're just talking about how they go about producing that product or delivering that service. So a best-in-class strategy may well have, for instance, an oil company there, and it's making no call on whether oil is a good or a bad thing, but it's saying within oil companies, what are the best performers? Who are the most sustainable oil producers today? Whereas when we move on to sustainability themed solutions, there you are indeed starting to ask the question, well, how sustainable is this business really long term? Is this business contributing to the betterment of the world? Is it providing some sort of positive impact on society or the environment? Is it something that's likely to be sustainable in the long term because the product that it produces is particularly useful and is delivering a lot of externalities, right? And here we are really talking about sustainability as an alpha driver, because we also think these issuers are extremely well positioned to benefit from these trends that are happening in the world today. So some of the trends that I talked about are here on this slide on the right-hand side. You can see climate change, of course, being very important, but also companies that are providing more broadly ecological solutions or resource efficiency type solutions, water efficiency being a very important one. Also companies that are at the forefront of health and well-being and providing real solutions to impending health crises. Companies that are really making the most of this trend of inclusion in our world and promoting inclusion and benefiting from that. So there's a lot of different examples in these funds that we run that are called sustainable, of companies that are really out to change the world in some way, are disrupting industries and are benefiting from that disruption through very attractive profits. And indeed, this turns out to be very good investment strategies, high conviction investment strategies that deliver outperformance and alpha for our clients in the long term. And finally, last but not least, impact investing. So here, as I mentioned, there's a dual aim of providing a social or an environmental as well as a financial return. To identify a strategy that's really impact for us, we really take this, we're very disciplined about it. So we look for two things. One, the intentionality ex ante to have that investment, that positive impact. And we try to quantify that as much as possible. So that means that the strategy should have a target of some kind on social or environmental impact. Usually we try to take the approach of a net impact, because every investment has an impact, positive and negative. And so it's also important to take into account potential negative impacts there. And the second feature that we look for is this ex-post monitoring and reporting of impact. And so there we try to monitor the progress, we measure and report that back to our clients. So this do no harm principle is also very important, this net impact process that we have. Finally, just to leave you with this slide, all of this is wonderful, but we need to be transparent about it. And we have developed some very intricate reporting. We're trying to be as transparent as we can at Aegon, increasingly so, to give our clients a sense of what their portfolio is doing for them. How does it look from a sustainability perspective? Sustainability is not an easy topic to handle globally, I have to say, because many different clients, many different cultures, many different views of what sustainability actually means. So what we're trying to do with this reporting is present a multifaceted approach and a multifaceted perspective on how each and every portfolio behaves or is profiled from a sustainability perspective. We usually provide our own ESG views, so this is based on our own fundamental research and our proprietary categorizations. But then we also combine that with an external view from leading providers of ESG data, so that you also have this third-party opinion on what the portfolio looks like from an ESG perspective. We also give insight into all of the active ownership activities, because as I mentioned, this is probably the most impactful activity that we can have as an investor. And finally, we also focus on the carbon footprint of the portfolio and what is the sort of climate risk that's faced in that particular portfolio. So that gives you a taste of the journey that we've been on at Aegon. At this stage, I'll stop sharing my screen. I'm sorry I couldn't be with you in live format so you could ask questions, but I'm happy to take questions via email, or feel free to contact me after watching this video.
Thank you so much, Bruno, for such an insightful presentation. It was really interesting to know all this year of experience of Aegon in the sustainable investment industry. I also like the different strategies that you presented in all this spectrum of sustainable and impact investing. So in that context, I would like to ask a question regarding to how do you envision the future of the sustainable investing industry for the future?
Thank you very much. That's a very good question. I think like the rest of the industry, there is a hunger for more data, more insights, and more quantification insofar as it's possible. So I think one of the key trends that I expect to see in the sustainable investment industry is a significant increase in the amount of environmental and social and governance data that's made available to investors to make their decisions. I expect that to become more comparable over time. At least I hope, maybe that's wishful thinking, but more standardization. And I expect artificial intelligence to really help us make some of that data available. However, I do think there is always a space for qualitative human analysis when it comes to environmental and social and governance issues. Primarily because there are issues that you can't quantify. It's as simple as that. If you're talking about human rights breaches and violations, it's not something that you can easily plug into a quantitative strategy. And so I think there is always going to be a human element to sustainability and sustainability analysis, particularly, that really adds value there. I think this will happen for a long time. And I think another key trend that we will see is indeed increased scrutiny from regulators and governmental organizations that will be more and more interested in the power of sustainable investing as a policy tool to achieve certain real world outcomes. We already see that with the sustainable finance package that's coming out of the EU. How successful it will be, only time will tell. But I think it's an interesting development to watch to what extent sustainable finance is used as a policy tool to achieve real world outcomes. And the last trend I'll leave you with is the impact trend, and that I'm really passionate about and very positive about. I think impact investing is here to stay, and I like the fact that we are now turning towards this lens of impact to look at all types of investments. We're no longer worried about not investing just in tobacco companies because they have a potential bad health benefit, but we're going much further and asking how impactful is each and every economic activity, each and every business. What is the net impact of that business? Is it worth us mining lithium in Congo to build electric vehicles in Tesla to decarbonize the transport grid? These are interesting questions to talk about, and I'm very positive about this lens that we are now using to look at all investments.
Okay, Bruno. Thank you so much for your time, for your answers, and for such an insightful experience. Well, I think we are at the end of this event. Thank you.
Thank you.